So in today's Lunchtime Stock Club for May 11th, 2020, I'll be taking a look at the market and giving you some additional insight into some tools that you can use to refine your earnings projection methods for the next 5 years based on a contraction of the economy and a slowdown in corporate growth for many of the companies that you may be owning in your portfolio. Let's start with where we are in the market year to date. Of course, here is the graph looking at the S&P 500 in blue, the S&P SmallCap 600 in green, and the EFA, the Europe, Australasia, Far East Index, in red. And as of this morning, the S&P 500 was down just 8% for the year, so quite volatile. Nowhere near yet the peaks that we reached at the end of February, beginning of March, but well above the bottoms that were established just about a month, 5-6 weeks ago now, in around about the third week of March. So the market's continuing to perform moderately well. When you look at the S&P 500 PE ratio, it is right about 20 on a trailing basis. And interestingly, as of today, the projected PE ratio for the S&P 500 is also just about exactly the same figure, 20.9, which indicates that based on estimated forward earnings of the S&P 500 compared to trailing 12-month earnings of the S&P 500, that there is 0% corporate earnings growth amongst the constituent companies of the S&P 500 index, and that hasn't happened for quite some time. Of course, we don't know what the future may bring, but certainly very interesting. And you can see where that 20.9 PE ratio is compared to the history of the market going back to the 1870s, and certainly the last 2 decades, 3 decades now have been filled with a lot more volatility, some major ups and downs of the market, and since the last bear market that ended in 2009, the market had been on pretty much an upswing, but kind of flattened out, as you can see in 2018 when the S&P 500 declined for the year, and then another good year in 2019. But now here we are, looking ahead and looking at a P/E ratio for the overall market based on trailing earnings of 20. I much prefer the P/E ratio to be closer to 20 than to 25 in terms of valuations when they're much above that 25 level. I think we get into warning territory, as most of the companies in the S&P 500 are large cap stocks and are slower, mature growth businesses. So all things equal, things like seems like things are as confusing as ever. And when you look at it, here's the S&P 500 earnings based on trailing 12-month estimated earnings for the S&P 500, and you can see they are at an all-time high. Of course, we expect those earnings to at least flatten out for the next 12 months. 2020 is obviously going to be a difficult year for many companies, but there will also be companies that will be benefiting from the current situation and whose growth trajectories won't be affected or affected as adversely as many other companies. Of course, every peak is a peak that will see a decline at some point. So no surprise, every time the market reaches new levels, it will contract a little bit. Every time companies' corporate earnings go up, they're going to retract a little bit at some point. So it looks like this is the peak for now, and maybe a year or two before we get back to this level of earnings for at least for large cap stocks. What seems to be true about the market year to date, and certainly right now, a lot of headlines in the last week about the market. Why is the market going up when so many companies are not expected to perform well, while unemployment is so high, while the economy is largely shut down, and there are various explanations, but to me, the one that makes the most sense is that the market doesn't rely on fundamentals. The market is driven by emotion. And right now, things don't seem as bad as they used to be, as they seemed back in March when everything was in a great state of flux. And now we've had a little bit of recovery, and people are saying, yes, maybe unemployment is bad, but a lot of the country is still working. There's a lot of the move towards a remote workforce, by and large, seems to have been pretty effective. And so people working from home, at least in the short term, we'll see over the long term, certainly with kids being out of school, that's going to affect the workforce, the ability of the workforce to work remotely. If everyone's at home, including the kids, that makes it more difficult to maintain a full-time workload schedule. But you know, from my perspective, certainly things could have been a lot worse. Certainly things might get worse, but the fact that they haven't as of yet is maybe the light at the end of the tunnel that is causing the market to provide a little bit of a little less volatility. The VIX index, I noticed today, had come down quite a bit from the peaks in March and early April. And so the volatility has declined considerably. It's still pretty high relative to the historical levels. So the worst may be yet to come, but when you start looking out 6 to 18 months, it's pretty easy, and I think for most people to see a return to normalcy, or at least an adaptation of normalcy, reflecting on what people have learned. Not all companies and industries are going to be affected to the same degree. When you look at some businesses, you see a lot of different levels of responses, and analysts making lots of different predictions. You know, Netflix continues to chug along, and it virtually seems unaffected by the crisis, and perhaps even buoyed a little bit as people are spending more and more time at home and looking for entertainment. Then all of a sudden that Netflix subscription becomes a lot more affordable. It provides access to a lot of entertainment. On the other hand, Disney launching a high-profile streaming service, and that's getting a lot of kudos and people signing up for it, but it's probably not enough to offset huge portions of their business that remain shut down due to quarantine, the amusement parks, and the travel, cruise ships, and other travel-related, hospitality-related part of their business is not obviously been affected to a large degree. So we can look on a company-by-company basis, and that's the advantage of individual stock selection, is that we can look at companies carefully. We can, with that long-term perspective. No one is, I don't think, really concerned that Disney is going to go out of business, but they may have a tough time. But you know, Netflix, Comcast seem to be moving just fine. So again, those are just some opinions and some observations, and you can apply that thinking as you go forward. What is often seems most obvious isn't as obvious once you start digging in, and that's the job of you as an individual stock picker. So I've covered this in prior webinars and our toolkit webinar, and we're going to take another deeper dive today in calculating earnings growth in uncertain times. I have done a little bit more work on the spreadsheet that I put together last month. And the idea is that we know a lot of companies are seeing their earnings going down in 2020. We know that the first 1, 2, 3 quarters of the calendar year are going to see some pretty devastating results from some companies. Now we've got companies reporting on their first quarter. First quarter, if they're on a calendar year, the reporting deadline is this week. So we should hear from most companies that had a March 31st quarter end for the first quarter. We'll hear from retail stocks in another month, companies with a January 31st first quarter or fourth quarter end. So we'll start hearing from those companies in another month. But the offshoot of reporting season is that analysts have a little bit more information to go on to make their projections for the rest of the fiscal year. So seeing large swaths of upgrades, downgrades, earnings estimate adjustments coming from the Wall Street community as they integrate what they learn from first quarter results for the companies that they follow. So I've puts us in a better position now than we were in a year ago. And my thinking is that if we have analyst estimates, we might have company guidance, but I don't think a lot of companies are going out on a limb providing guidance for their earnings expectations for this year, for the rest of the year, for the next couple of quarters. Most companies that had guidance withdrew it. They may provide some broad, very, very broad guidance, but I think most companies are trying to not go out on a limb with providing guidance about their earnings, their ability to grow their earnings in this period. So, but we can look to some of the analyst information. And so my thinking is that if we have estimates for 2020, fiscal 2020, if we have estimates for fiscal 2021, which are very available on websites like NASDAQ or Yahoo Finance, that we can start from that level going forward for 3 years, from the second year going forward, go out 3 years at a long-term growth rate, and then we would have a 5-year earnings number that we could use to calculate our high price. We could back into a growth rate that would start at the last fiscal year earnings, in other words, 2019 fiscal year earnings, and then project a line that matches up with our method of calculating earnings as we go forward. You could do something similar perhaps with, there are lots of ways that you can modify this model. I'm looking at earnings just as a way to demonstrate it. So as I go through it, I realized that at Yahoo Finance, you can create a portfolio. This is a part of their free service. And you can create different views of the portfolio. So a portfolio is a basket of companies. You can have a couple hundred companies in a Yahoo Finance portfolio. And then you can create a view. And there are several dozen different metrics that you can add in including 52-week high and low prices, dividend yield, all sorts of values that you can add in and create, in effect, a custom report based on the companies in a particular portfolio. You can have build different portfolios that all come back to that same view or same sets of views. They have some default views that they create, but the ability to create a custom view allows you to bring in the estimated earnings for next year. So in other words, this is the second fiscal year going forward. So not, in this case, fiscal 2020 would be this year, fiscal 2021 would be next year. And so that earnings estimate from analysts, from Wall Street analysts, that consensus number is available in a portfolio view that you can create. So the thinking is, oh, well, create my portfolio. You can copy and paste symbols in very quickly, add them one at a time. You can create this view, and then you can just update it. And then once you've got that data, copy and paste that table from Yahoo Finance into the Excel spreadsheet, and boom, add in the last fiscal year earnings, your long-term expected growth rate, and calculate it'll calculate earnings out for each year that you can plot on the graph, as well as the long-term growth rate. So that's the explanation. Let me show you how this works. So I've come over to Yahoo Finance, and I've got a portfolio here. So you can see there's about a dozen different companies. My view of the portfolio, I like seeing the earnings date. I left that in because that's really interesting. That'll tell you, one, you look at a company on this list like ULTA, at the end of May, will be reporting earnings. Again, it's a retail company. They've got a fiscal year that ends on January 31st, so they're a month behind companies that are matched up with the calendar year, with the fiscal year that matches the calendar year. But you can see every other company on this is not reporting until the next time till July or August. That says, you can intuit from that says these companies have reported already because that's more than 3 months out going forward. So I've created this list of ticker symbols. I didn't worry about number of shares, just put in the ticker symbols. That's all I'm interested in. Now I'm creating my view. And my view just has 5 columns in it. One is the symbol, the company name. Number 3, the third column is the earnings date. So that's the date that earnings are expected to be announced. 4 is the trailing 12-month earnings, because that's useful information. And 5 is the earnings for next year. So yes, this is the free version of Yahoo Finance. Phyllis just asked, so yes, to clarify. Yeah, and we'll talk, I'll address some of the other questions a little bit later. So this is a very simple view, just 5 columns. Now you can see it's got the values there. So I just select the data, ignore the header row, but just select all the data, right click, select copy from my web browser. So pretty straightforward there. Flip over to the web browser, paste in as text only, or match destination formatting into Excel, the Excel spreadsheet. So you can see all the data has just been brought over. And sometimes the way it comes in, it might come in with extra rows, depending on your browser and some other differences that you might be using. So you can resort resort the table to make sure that you've got the information entered compactly. Once you've done that, enter in the last fiscal year earnings. That's something you can do once, and then enter in your earnings per share growth rate for each of the companies. So my thinking is that for most of the stocks that you own, your long-term expected growth rate that you used on the stock study up until the beginning of 2020 is probably close to being valid going forward. Of course, you're going to research it, you're going to figure it out. Maybe you're going to reduce it a little bit, but the idea is that's the growth rate that you expect the company to resume once it gets through the next 2 years. So figuring that this might be a down year for 2020, 2021 might be a recovery year, and then 2022 through 2024, they'd be back on board with their long-term growth trajectory. Again, there's a lot of assumptions built into this, and you can modify them as you see fit. You can look at what Value Line might have to say. You can look at other sources of information. You can look at the long-term growth rate on Yahoo Finance, for instance, in the analyst section. Again, the question would be, does that growth rate apply? Is that growth rate taking into account the decline, or is that kind of the average growth rate? And my sense from what the work that I've done is that if you look at the 5-year earnings growth rate on Yahoo Finance, if you scroll all the way down in the analyst section, that growth rate is the average growth rate, including the declines of the next year or two going forward for many companies. For other companies, it seems to be relatively the same. It's a 15% average growth rate, something that's very common. So once you've done this, the spreadsheet calculates your earnings for the next 5 years, and you can enter then those values. So I'll flip over. Here is Yahoo Finance. This is the free version of Yahoo Finance. So there's nothing paid to it. You can see my columns here. You can see I can select with my mouse, right-click, copy, and then I flip over to my spreadsheet here, and I've included some help in this help box here. You can kind of move that out of the way, and again, match destination formatting seems to work fine, something like that. And then what I would do is I'm going to sort this. So just go to data, sort by the symbol from alphabetically. And you see I've already entered the data here for the last fiscal year earnings. And again, the trailing 12-month earnings includes the first quarter of this year for most companies. So the last fiscal year earnings are going to be different than the trailing 12-month earnings for many companies. There might be one company on this list. No. I was thinking that there might have been one company on this list that hadn't reported yet, but there isn't here. Here, I'll make this a little bit bigger so you can see it. So it's out of sequence, right? This is trailing 12-month. This is 20 In effect, it's fiscal 2022. This is fiscal 2019. This is the growth rate for post-recovery growth rate. We'll call it that. We'll assume that this year and next year are down years and then going into recovery. So after the recovery of 2021, and again, that's a blanket assumption, what we expect the growth to be. And then now the program just calculates earnings for each of the 3 years. And then this final figure over here, the average 5-year earnings per share growth rate, that's the value that you would enter into Toolkit in order to calculate growth from last year going out 5 years. So just as an example, I'm going to look at ULTA, but here's Disney. I'll highlight Disney here in the middle. So you can see that last year they earned $6.27, but in the trailing 12 months they earned $2.97. Analysts are estimating they'll earn $4.49 in the year after next. So that also assumes that this year is going to be pretty bad. So starting from $4.49 in 2021, 2022 at 12% growth is $5.03. 2023 continued growth at 12% is $5.63, and then 2024 is $6.31. So you can see why some people are not really very excited about Disney, because they're getting hit so hard that even 12% growth, once they recover, the starting point will be so low that it's really flat, right? So from $6.27 to $6.31 in 5 years is a pretty flat growth rate, because earnings have fallen in half, it appears, or worse for the particular company. And again, based on analyst estimates, and your information may be different. Your chosen analyst may have more information or have a different model, but this kind of gives you a rough sense of why it doesn't seem very bad that 1 year the earnings are going to go down, but it's not like for a company like Disney that when they reopen their parks, they can double the capacity and get twice as many people in to make up for the lost revenue. In fact, the inverse is more likely to happen, that when they open the parks, they're going to have to, the expectation is that they might have to limit the number of people who come through on a daily basis. And so their capacity might be much lower, and certainly some of the costs might be less, but on the other hand, certain other costs are going to happen no matter whether the park is open or closed. So so this is one particular approach on Disney. And again, there might be some other aspects of the business that will be affected in different ways, but that's the way one way of thinking about it. So let me talk about the example of ULTA. So here is the stock study using 16% growth, which is the investor advisory service target growth rate for sales and earnings for ULTA prior to this year. And so the company earned $12.15 last year. At 16% growth, that's better than a doubling, so that puts earnings at $25.52 in 2024. Okay, so we know that a company like ULTA makes beauty supplies. It's a retail store, it's non-essential. They've got hair salons and boutiques in the stores as well. Those are all shut down, may possibly soon be reopening. But obviously a company that is pretty seriously affected by the COVID-19 pandemic. And so if you look up what analysts are expecting, analyst estimates for this year have the company earning $7.80, going up to $11.60 in fiscal 2021. So 2 years from now, ULTA will still not be making as much money as they did in 2019. And again, probably not a lot of avenues for ULTA to make up the revenues or earnings shortfall. They're just going to be starting from a lower level, perhaps at a lower, with a lower growth rate going forward. Certainly expansion plans continuing to build new stores, all up in the air. So that's what analysts are currently seeing as of today for ULTA going forward. So we're going to take that data, and I'll flip back over to my spreadsheet. Here's the ULTA line. So last year, 12.15. Estimate for 2021 is $11.60. Trailing 12-month earnings, the same. So at a 16% growth rate, that would get earnings back to $18.11 in 2024, which is an 8.3% annual change starting from this figure right here, from $12.15 going forward. 8.3% a year gets you to $18.11 in year 5 or 2024. So I'll take that, this is the important number, 8.3%. I'm going to flip back to Toolkit. I'm going to enter the 8.3%. So got the figures all pointed in. I've got 8.3% that I've added in here. I've left the sales growth, but we might make it the same for the sake of argument. And you can see here that 8.3% from 2019 gets you to $18.10 or $18.11 in the spreadsheet, which is close enough. So shows you that recovery as it is expected to happen right now. So, but that's a big difference. If you were making a model based on earnings of $25 in 5 years and the earnings only are $18, that's a significant decline in your expected total return. So we'll flip back on the back of the SSG. And so here we have our high and low PE ratios, which you may or may not have adjusted, but what's important is this is the section 4. A high PE ratio of 27, again, that comes from the Investor Advisory Service. Estimated high earnings, 1895 is actually 1811, gives you a high price of $157. Or I'm sorry, $488.70. It's currently $230. So yeah, it still puts it in the buy zone right now. It is 3.6% to 16.3%. And so 16.3% total return on an annualized basis, assuming that this model turns out to be correct. So the thinking is that the spreadsheet is an aid to help you. You can download this. Don't overwrite any of this information up here. The shaded areas are where you can touch stuff. If you overwrite the formulas here, then it's not going to work. I left some space for you, but you can read the directions, drag those around. The spreadsheet has the same tools, the same formulas and worksheet to do it on a company by company basis. So you can do one company at a time. This kind of, I think this is a little easier. You can figure it out and work with an entire portfolio, review it all at once, figure out what these values are and bring them in. And again, people who are more computer programmer types can figure out a way to maybe grab this information dynamically, pop it into a spreadsheet, adjust the formulas to make it work in different ways, pull in the information from the Toolkit database. But I wanted to make something that was accessible, that you could work with without having to know a lot about how to work with Excel formulas that go into it. Again, this is all just sample data here, so don't get too worked up over it. Okay, so Neil says, Amazon is now a competitor with ULTA. How much impact will that have on the stock? Yeah, Amazon's a competitor with everyone. My sense is that ULTA does have a little bit of a moat, because if you're buying beauty supplies, I can't imagine a lot of women who decide, oh, I'm looking for a new shade of lipstick, to rely on an Amazon photograph to show you the color. Much rather go into the store, look at the samplers, look at the actual, color live in the stores. That's what they're all about. And certainly the beauty shop salon component of ULTA is not something that Amazon is doing just yet. Maybe they'll figure out how to deliver your haircut to you, but that's not part of the online model just yet. Amazon is another company that reported first quarter earnings that were below expectations. They have a model that they were able to pivot on to provide for ongoing operations, but they did run into some wrinkles in the first quarter, so it's not the perfect company. That may be a good opportunity, but again, that depends on your own analysis. So I'm just kind of giving you some insight there. We're going to wrap up. We're going to talk about some company ideas that you might think about for your portfolio. Then I'm going off to do across town virtually to do a presentation for the eMoney Show at 2:40 today, where I'm going to talk about investing in the stock market during these turbulent times. So we'll be cutting this one a little short. The Investor Advisory Service in the most recent issue, some interesting stock selections. One was Align Technology, which is a company that we'd covered before in the newsletter. It got to be a little pricey, a little overvalued, we felt, so it was dropped from coverage, and now with the market pullback, it seems like it's a company that is back into a reasonable valuation range. This is the company that makes the orthodontic teeth aligners, so kind of an alternative to braces that are invisible or low visibility, not really seen. And they've been just growing really, really well, and with a lot of global opportunities out there. So the company to take a look at. Lululemon was also a company, followed it in the past. This is the athletic gear, athletic wear clothing chain out of Canada, but again has a very loyal following. And the decision was, this is a big brand that will come back around when as the economy resumes an upward trajectory at some point, but the valuation just was very compelling. On our SmallCap Informer, we took another look at South State Bank, which is a South Carolina-based bank, one of the largest independent banks in the state, and in the top 3 or 4, I believe, of all banks doing business in South Carolina. They've been growing by acquisition, expanding their footprint bit by bit, and I think they just have a really well-managed portfolio and a loan portfolio, and just the right mix of growth by acquisition, organic growth, and opportunities for future expansion seem pretty strong. So at a reasonable valuation, seems like a good opportunity to pick that up. Physicians Realty Trust is a real estate investment trust, but their business is medical facilities, and they rent office space and facility space near major medical centers, and often 2 major medical centers. So some of the largest medical centers in the country will lease space from Physicians Realty Trust. So that puts their real estate portfolio actually in pretty good footing. We don't expect these major medical centers to go bankrupt or shut down. We expect a certain degree of continuing operations from healthcare facilities, even as elective surgery has been perhaps slowed down. It doesn't look like there are a lot of leases that are going to be broken by its customer base. So it seems like an interesting opportunity, higher yield, and when you look at the composition of their customers, they are something like 35% 80+% of their customers are investment grade rated businesses themselves. So this is very top tier kind of stuff. So an interesting healthcare play, I thought, and just a way to get into the back into the REIT, back into some dividends without a whole lot of excess risk that you might face with a certainly hotel REITs are being hammered, and we'll look to see about real estate retail REITs, how those will be faring, as many of those shopping centers and malls have been shut down or running on fumes for the last couple of weeks. But those are some ideas for you to take a look at as we're moving forward. Okay, well, I see a couple of questions that I'll take offline as much as possible. Tom asks, is there a way for Toolkit users to copy data to Excel or Google to compare portfolio ratios? The Toolkit database is an Access database. So if you're comfortable with Access, you can actually access the company information. Beyond that, the only report that's exportable as a text file in a text format that you could copy and paste into a spreadsheet is the portfolio summary report, which just gives you the information that's on that report. Otherwise, you can export stock selection guides in a text format, and the SSG file itself is a text format. So if you export SSG files, you would have individual text files. You can copy and paste those into a spreadsheet, for instance, and that would get you access. So there are some ways it can be done. They're all unsupported. We can't support you, but some diligent Google searching might turn up some of that information, and that might help you. Beyond that, good luck. You're on your own. All right, well, thank you all so much. I do have some events on my schedule. Certainly over the summer, things have slowed down quite a bit. The Better Investing chapters, Central PA, Dallas, Puget Sound, Philadelphia have events for later in the year. These are all pending. I have another event in DC in July for the AAII and Better Investing chapters there. That again, we're just waiting to see how quickly things open up. But we continue to produce our virtual events. I'll be participating in the virtual Better Investing National Convention in June as well. That didn't make it on this slide, but you'll hear about that event and be able to sign up for it. And of course, keep calm and stay the course. That's been my mantra through these difficult times. So hopefully you will continue to be able to maintain a cool head and focus on common sense and not let emotions run ragged as we deal with everything that the market and the economy and the health of our country comes to face us in the coming weeks. So I wish you all the best. Please stay healthy, stay well, and we'll see you at our next Lunchtime Stock Club.